So moving along to the long call calendar spread. The long call calendar spread is just the opposite of the short call calendar spread, where we are going to have long call in the August or the further expiring month. And keep in mind, cheap calendar spreads will drive you crazy. That means that if you're trying to pick a very inexpensive underlying, those inexpensive underlyings, although you can do a lot of them and they don't take as much margin out of your account, then you just aren't risking really enough. And I wouldn't necessarily say you go with the Googles or anything like that, but you need to go with something like SPY or something along those lines where it's, moderately priced for the most part. Don't always pick the cheapest one to implement these strategies, because if you have cheaper premium, then that premium doesn't have a lot of decay left in it, or you won't see a lot of movement in that decay. We want to implement this strategy in a low volatility environment. If volatility or Vega expands, the short call and the short-term option will be negatively affected, but it will be offset by the positive effects of Vega on the longer duration options contract. Because remember, the longer duration options are more sensitive to Vega or volatility. And the trader is creating a strategy that has defined risk and is looking for the underlying price to remain in a tight range, thus taking advantage of the time decay or the theta. And remember, the shorter duration options are more sensitive to theta. So in a perfect scenario, we would have a stock that was basically trading flat along the curve, and something that doesn't have a lot of volatility in it, is pretty humdum, I guess, if you will, a stock that wouldn't be really exciting to trade necessarily. That's the one where we can start implementing these long calendar spreads, because we can take advantage of all the things that are not happening. In building a long call calendar spread, you simultaneously sell a near-term expiration option and buying a longer term option expiration with the same at the money strike price. Like I said, ideal situation would be at the money, but you can use slightly out of the money, or the nearest strike that would be out of the money. And because short-term options expire before long-term options, we have the opportunity to roll the short-term options to reduce our cost basis on the strategy. If we continue to roll out the short call, which is in the front month, if we went from the weeklies to the monthlies or even a further out weekly, we can continue to collect more credits. I mean, as we sell it out for maybe a 50% max profit and roll it out into a little bit further duration, then we can keep this dream alive and we can keep increasing our total net lick, as we call it, which is our total premiums received. The max profit. It'll be heavily dependent on the implied volatility of the contract in the further duration. We want that implied volatility to expand, because otherwise it's not likely going to cover the cost of implementing the strategy. Now, with this being said, we want this implied volatility in the further duration months to expand at a rate to which it will surpass the theta decay that it's seeing. Now also, we are going to be short the front month, so we're going to see a lot of theta decay in there, but a perfect world would be to see the theta decay and a little bit of volatility spike on the back end, and that would increase our max profit tremendously. And the max loss of this is the debit paid to implement the strategy. Remember, anytime you pay a debit, your max loss is the debit you paid, because an option buyer gains the right but not the obligation to exercise the contract. So your max loss is the debit you paid. And the break even on the long call calendar spread is similar to the max profit, in that the break even will vary based on the changes in implied volatility. Like I said, a snapshot that I'm going to show you here in these charts, it does show a defined area of a break even where the line crosses our dotted line. But having said that, volatility, you can see right here, will expand and contract as the life of this strategy goes on, and the theta will also contract as the life of this strategy goes on. So how quickly those happen is really going to affect your break even. And we will talk about the time that you need to start implementing these strategies, because that is going to be very, very important to the success of these, is the right timing, the right day at which we have till expiration, or the right couple of days that we have till expiration, and the environment around this particular underlying, making sure that either it's in a high implied volatility or a high historical implied volatility. Those are going to be things that we need to weigh and determine which one of these types of calendars we want to implement. So again, I've created the long call calendar spread on this chart, and at the bottom I've created really two calendar spreads. One is entering it as a calendar spread, the other one is as a legged calendar spread. And I need to say, a rookie mistake is to actually leg anything in or out. Create your defined risk. If you're creating defined risk, and stick with that strategy. Don't try and change your strategy throughout. You implemented it one way, you had your thoughts, don't start second guessing yourself. The other thing is they say you have about a 50-50 chance of legging a spread better, but the fact of the matter is the 50% of the times that you don't leg it better, you've really hurt yourself. When legging the strategy, the gains that you make on legging this strategy right are not going to cover the losses you incur when you leg it incorrectly the other 50% of the time. So you will net out less. Also, when you create a defined risk strategy, the counterparty likes that, and it will give a tighter market because they know that they're getting into something that's defined risk. If they're forced into legging something, then they're going to have to add some of that thought process into their pricing. So you can see here on this long call calendar spread, we did it for a 66-cent debit or a $66 debit, and the breakdown of that was, as you can see, in the long August 62 call we paid $2.27, and in the July 62.5 calls we sold it and collected $1.61 or $161 versus the $227. That difference is very close to 66. So as a matter of fact, this one happened to be right at it. So that, in this case, it would be done correctly, but not to say that I would get filled at those exact prices. So that is the design of the long call calendar spread.